Hey guys, today we're going to talk about private debt funds. So the industry, so I'm going to walk you guys through the industry as a whole on this whole concept of private debt funds. And then we're going to talk about us, which is the hybrid debt fund. So the first question is, what is private debt? So private debt definitionally, according to Preqin, is private debt or private credit. It's the provision of debt finance to companies from funds rather than banks, bank-led syndicates, or public markets. So, as opposed to going to a public entity or a bank, you're going to go to more of a private institution. That's just a simple concept. And when you think about private debt, a lot of times in our world, we think, well, that's private debt against commercial real estate. It's actually not the predominance of private debt. Private debt or private credit predominantly is actually for what they call middle market lending against companies. So you're going to see a tremendous amount of private credit or private debt against an actual business as opposed to a piece of commercial real estate or a collateralized loan obligation. So just so you understand, in the private commercial real estate debt industry, I'm not saying it's teeny, but it's actually a smaller fraction of the larger private credit. So whenever you hear that. How large is the market? Assets under management are currently about 812 billion, give or take. It's probably higher than that, is my sense right now. And there are about 4,000 investors. And when you think about an investor, that is probably a combination of actual lending institutions and or the investor groups that might be working through these institutions to deploy the capital. So when we talk about assets under management, the actual investors in there, that's what we're talking about, the combination of those two. If you look here, you can see all the way back in 2010, if you probably went even before then, which would have been in the credit crisis, the tumultuous 2008 cycle that happened where the credit market just went completely upside down. Previous to that, it was a pretty small world for private credit, private real estate debt. And so after the crisis, you started to see a lot of growth in the private lending space. It's still, again, a smaller fraction than the larger components, which are banks and life insurance companies, agency financing, CMBS, but it's moving its way up. And I believe sincerely, this is one of the reasons we're going here, as you looked at the market and scanned it, that it's going to become a larger fraction over time as it becomes more and more difficult to go in and get a bank loan and work with these large red tape institutions are not going to get any easier to work with. And so you can see here the distinction between what they call dry powder, which is money that they have not deployed. Okay, they always keep liquidity around, to the red is the obviously what's been deployed and the unrealized value. This is just understanding the capital structure. I know Tom has gone through this in the past, but I liked this picture here where you have, senior debt, where you are first deed of trust against the asset. You then have what's called unitranche debt. Unitranche debt is that you have senior and subordinated debt all in one instrument. So they might do a first and a second all together. Ours is a little bit like unitranche, even though we don't have a subordinated debt, but the way we structured it probably feels a little bit like that because we're going so far up the stack, going up in a higher loan to value, but we are senior debt. We're not subordinated debt because we don't have a subordinate position. That's just taking a second behind the first deed of trust. And then mezzanine debt, which falls right in between. It's usually either going to be above that senior debt, but below equity. It just is sandwiched right in between there, that mezzanine debt. Higher, it's more expensive, and it is actually debt. Then you have preferred equity, which isn't on here, which is feels like debt, but it's actually equity in the limited partnership, where they're actually going to receive a yield, but they typically are not getting upside. They can, but generally speaking, they're the first one. That's why they call them preferred, is if there's ever a loss or default, they're the preferred ones to get out first. And then obviously just straight equity is, highest returns, highest risk. So you can see here, priority of payment and liquidation is really where you stand on the stack. If there is ever a default, the senior lender is always going to get paid back first, then unitranche, then subordinated, then mezz, then equity. Okay, so this is the highest risk over here, lowest risk when it comes to liquidation if there's a foreclosure. And then application of losses has to do with tax benefits, typically speaking. So senior debt gets the highest risk, meaning they don't get the best tax benefits. And then obviously the lowest risk or best benefits is more the equity. So I just like that picture of the capital structure. This gives you an idea of what we would consider risk and return in the fund type. So if you look here, direct lending is a larger portion between 2011, 2017, and then up here on this whole XY axis, you can see the internal rate of return, or the net IRR of standard deviation. This is risk. So as you go up higher risk, right? Higher return. So you start looking at distressed debt is more volatile and return. Over here, you're dealing with mezzanine debt is lower risk, higher return. That's why a lot of people like mezzanine debt. And then obviously lower risk here and medium type of returns and more of the direct lending. So this just gives you a span of risk versus return on the asset types. When we're dealing with institutional investors, why do they invest in private credit, private debt? You can see up here, it's much more diversified for them. It's more of a reliable stream of income, low correlation to other assets. So this is something that is attractive, very attractive, especially right now with the volatility. Private debt tends to be much more attractive when things get a little bit more volatile. So that's just a scan of the market to educate you guys so you can at least understand some of those 30,000 foot view elements. And then we want to talk about the Hybrid Debt Fund 1 LLC, which I call the future of commercial lending. So our specific program that we are rolling out includes the following. The first one is it's a one-stop loan. That means that you get a first deed of trust that goes as high up the stack as you can possibly go. And you're not having to go get, bank loan, then get some mezzanine or pref, and then get your LP. Here, we're trying to do the whole thing in one shot in the most preferred situation. So that also means we're very high leverage. So we're going to push up the stack to probably, 80 to 90% possibly. And we call that squeezing out the pref and the LP, which means that we're trying to make those go away for the borrower. So they just have this one-stop shop place to go. It saves them money in the right situations. We offer a fixed rate as opposed to floating. Most of the construction and or rehab loans, generally speaking, are going to be floating rates. But we wanted to fix the rate. It lowers the risk for the borrower, which most of them have felt the pain of that now. So ours is going to be very attractive going forward, as they felt what happens when your interest rate goes from 4% all the way up to 10% in less than 5 months. Things get really sticky. And then for us, we have upside capture. Means that we're a lender, we're not in their limited partnership, but we do have upside capture. We're going to collect 30 to 35% of the profit and when they sell it, which helps us give our investors much better returns for the risk profile of lower risk debt. So that's why we henceforth the hybrid debt. It feels like it is debt, but it feels like equity. Obviously, ours is focused on rehab projects and or construction. So before I go forward, are there any questions about that? Anything so far that I've talked about you guys want answered?
Yeah, so to confirm, we are not part of the entity, the borrowing entity, right? We have nothing to do with that.
That's correct. We are 100% a lender. We are not in their entity at all. We are purely a third-party debt lender. We just have a separate legal document that allows us to collect part of the profit.
And is there flexibility on the third parties that if the client says, hey, I want to use this group, will we have to approve that, or what does that look like?
If they want to use third-party vendors?
Yeah, for appraisals and environmental.
I would say because we're hyper-focused on our process, we're probably going to be pretty focused on using ours just because we want to be super streamlined.
Yep.
But I think there'll be some situations where we can accept if somebody's already done a phase one somewhere or the Alta survey, because again, we'll probably be able to go quicker just because of that. But the idea is that we want to just have everything baked in, and so we can go really fast.
Makes sense.
Yeah.
Thank you.
Good question. Anybody else? Okay. All right, I'm going to walk you through a scenario. We're going to just make an assumption that somebody is buying an apartment complex, or let's just even say it's a retail center for $5 million, and that includes all of the rehab costs. So the total project cost is $5 million. We're going to lend them at 7% is going to be the interest rate. We underwrite to a 30-year amortization. So if it ever goes to amortizing, that's what we would use, as long as the economic life is there. So we use 30 years as the amortization. This just gives you an idea of what happens on the backside for our particular investors, which I'll get into more detail later. So I won't go too much into that right now. You'll understand it, but just assume we're obviously going to 85% loan to cost in this situation. Again, we'll chat about this later. This is a management fee that the fund charges. And then the current NOI in place today is 300,000. We're just making that assumption. And then the state, so that means today, if we take the historical trailing 12, there's 300,000 worth of net income. The stabilized NOI in the future, what we would call that stabilized time period, let's say it's 3 years down the road or 2.5, it's 420,000. This number right here is very important for us because we call it yield on cost. And you're thinking, what the heck is that? Well, we take the future stabilized NOI that the developer believes and we've underwritten to confirm it. We take the stabilized NOI and we divide that by the purchase price or the cost up top, that $5 billion. That number is really important because it's our lick test just to see if we see something, north of 7.5, it's worth diving deeper into it because chances are the economics work out. When you run these math models enough, you start to realize there's one or two variables you want to look at pretty heavily that sort of tell you whether or not this is going to work. And so that is one of our major testing points we look at to see how high we can go on the stack. Otherwise it's just really difficult because of our cost of capital and the way that we underwrite for the future, essentially. So in this case, an 8.4% would be great. And it's showing that there's $120,000 what they call NOI increment, meaning that you're going between the 300 to 420, you're lifting at $120,000 in that period of time. We make an assumption that the cap rate sale is 6%, and then sales cost is 2%. So the 6% is just saying when that future NOI, the 420, if that was the date they sold, divided by 6%, that would give you your final valuation that you're going to sell it. So I'll hit the pause there. Any questions about that so far before I continue on our scenario? You guys tracking with me so far?
Sorry, can you just say what was the sales cost? What does that explain? Like, what is
So
it?
yeah, great question. The sales cost is you're going to have a commercial broker who will sell the asset for you to another buyer. And so we just assume that there's a cost of sale of 2% that's going to go against that purchase price. And so that's a number we need to know because that's part of what we're netting out to get to our final splits.
Got it. Thank you.
Make sense? Good. Any other questions? Great. Okay, so I'm continuing on here. As you can see, we on the fund side, we are going to collect 35% of what we call the NOI increment plus the net reversion. So we're going to be taking 35% of that net operating income every quarter when it's profitable. And then we're also going to take 35% of the net reversion, which means when we sell the asset, when the asset is sold, that we're going to deduct the sales costs that we just talked about. We're also going to deduct the debt that they have outstanding, which again, if we go back here, is going to be the $4,250,000. Okay. And then whatever that profit is, so let's just do some quick math for a second. If you take 420, which is that future NOI divided by 6%, that's $7 million. Okay. So if we take 92% of that, or sorry, 98% of that, because of 2% of costs, 6,860,000 minus the 4,250,000. Okay. That gives us $2,610,000 of profit. So that profit right there, we are going to split that between us and the developer. We're going to get 35% of that. So we would get $913,500. The rest of the money would go to the developer. That's how the reversion works for us. We get 35% of the NOI that happens every quarter, and then we get 35% of that profit when they sell. You guys tracking with me so far?
Yep.
Yeah.
Okay, good.
One quick question on the NOI part. Is that referring to the increase in NOI over the baseline from when they start, or is that just 35% of the total NOI?
It's a great yeah, it's a great question. We call it increment because if they start off, for example, Tom, right down here, see how it says debt service in place, interest only payment?
Mhm.
So notice that they're a 1-to-1, right?
Yeah.
So right now they're not making anything other than making the payment because their NOI is 300,000. What is their interest only payment? Look at it.
Yeah, the 200. Yeah, the 297. Yeah, so they're just barely above it. Yeah.
Yeah. So they're not making any profit. So there's nothing we can take. But
Yeah.
when they increase it, then the answer is yes. We would participate in anything in the increment that's profit.
Okay. That's what I was trying to wrap my head around, because I was like, well, how do we buffer then if they're coming in as a 1-to-1 and then we take 35%? But that makes sense now. I follow.
Yeah. So it's anything that's profit. Okay. And then in here, this is just behind the scenes as the investors. What happens is try to see if I can best describe this. So what happens is there's this 80%. So what we do when we get that bucket of money that comes in on the NOI, so let's just say, for example, one quarter that we got, 50,000, okay? Then what would happen is the investors who invest with us get 40,000. They get 80% of that bucket. The rest of the 20% goes to our firm. Okay. So we split it 80-20. So just think about this bucket, this sort of pie, and then 80% goes to the investors, 20% goes to us. Because again, we're running the fund, we're operating the fund, all those things, and we have costs, in the fund. So that's our portion of it. The bulk of it goes to the investors. We do get a portion. And then when it falls in that bucket, then we have to split it to get the A shares, which I'll talk about later, up to a certain return. And then the B shares get the bulk of it because they're the ones who take more risk. A shares take less risk, B shares take more. I'll talk about that further, but I'm just giving you a quick high level of that. So when we underwrite, we're trying to get to about a 120 to a 123 future debt service coverage ratio in order to determine how much we're going to lend to that borrower. So if notice right now, based on the underwriting, we're at 123. And again, we're using 7%, 30-year amortization, 4,250,000. That gives us our 1.23 debt service coverage ratio. Now, if all of a sudden we ran the numbers and we were at 1.1, we'd have to lower this portion, that B share, down until we got to the 123. So it might get us down to 80 or 75. Dan and I just did this the other day. Their yield on cost was like 6.4. They were maybe at 50%, right? Just because it was so skinny. So I'll stop there. Are you guys tracking with me on that? Does that make sense?
Yeah, so basically, in summary, we're trying to ensure that the DSCR future is at a 125, right?
Yeah, or
But
I would say 120, Dan, but yeah, somewhere right around there.
Got it. And that means that if we have to lower proceeds, we will do that to get there, or
Yes.
the deal might not make sense anymore.
Correct.
Got it.
So makes
And
sense.
it's because all you have to ask someone for to put it through the system is three things: cost, actually two things, the NOI in place and the cost. That's pretty much it.
Well, cost, NOI in place, NOI in the future, right? That's kind of what you need to know.
Yeah, that's great.
You guys tracking with me so far on that? I don't want to go too fast.
Quick question on the kind of going back to the NOI. So on the future NOI, when we're underwriting to that, are we considering are we considering our 35% taken out of the increase when we're calculating the new NOI or the future NOI?
No, because
or future DSCR rather?
Here's maybe an easier way to think about it, Tom.
Mhm.
We're only taking 35% of whatever the net cash flow is. That's probably an easier way to say it. I'll probably change the language. It's the NOI minus the debt payment, whatever's left over, we're splitting that. So it's not pre-debt payment, it's post-debt payment.
Okay.
Does that make sense?
Okay, so it's considered. Okay, I'm following it now.
Yeah. And then just so you know, on the one of the variables we try to look at too is, Dan, just so you know, is we want to look at in place, if we can get to a 1-to-1 break even on the in place income. Those are kind of the two things. Those are the guardrails, I guess, for lack of a better word. This is how you're making your decisions right here. If this was 120 and this was 0.7, that might get tricky. Because, you know, I'm not saying it's a deal killer, but we'd have to talk through it just to see, because then you've got losses happening. We're saying, how are you going to shore those up?
Got
There's one question on the, maybe I'll go into this a little bit more, but so the 35%, say for example, the 35% of the fund share of the NOI increment is the 80% of that 35%, if that makes sense. Like, is it divided 80 and 20? Okay, so like,
Yeah. I know. I think I know where you're headed. So just think about this. The 35% is before the 80% split. So we're going to take 35% of the money that comes in from the sale or from the NOI. Then we're going to do the 80-20 split.
okay, yeah.
Does that make sense?
I think that's what I was thinking. I was trying to
Yeah.
like kind of map it in my head. So yeah.
Yes. Good question. Good questions. What else? What else isn't clear, or what can I help answer? This is a great time to really do a deep dive and understand the program, the product, or fund. Okay, good. Okay, so what are the target asset types? Multifamily apartments, industrial, single tenant, triple net assets, retail, and storage. Those are the ones we're going to be focusing on. That doesn't necessarily mean we won't look at other things. I'm just saying the core are going to be those things. There's obviously little variables we'll look at as well. But that just gives you an idea on what we're really trying to go after in the fund. Target people are groups that have 3 to 5+ years in the target space. We want people to know what they're doing and not just winging it for the first time. We need to know their net worth is equivalent or higher than the loan amount. So if it's a $5 million loan, we need to have at least 5 million, preferably higher, but that's just bare minimum. Liquidity needs to be about 12 to 15% of the loan amount. So if your loan amount, again, just for the sake of discussion, is 4,250,000, then we need to know they have at least $500,000. Oops, I'm just going crazy here. Wow. Okay. You guys still with me?
Yeah,
Yep.
man.
Okay. So sorry about that. So 12 to 15% of the loan amount. Obviously, strong character and reputation is important. And then, we always look at fair and reasonable as opposed to over negotiators. So, make sense on the target people?
And will we still be kind of looking at how many properties they have? Will that be in the like kind of how we're targeting, or are we just going to focus on like their time of experience?
Yeah, I think that's a good question. Yeah, I'd say that would come into play. How many properties they have, what's the net worth of those properties. We'll definitely look at their portfolio. That would go into play in terms of their experience. Now, they may be what we would consider a merchant builder, where they don't really hold on to assets, but they just build to sell. That's okay too. We just want to make sure their resume shows that they've been in that asset type for a while.
Gotcha.
Yeah, good question. Anything else before we move on? Good. Here's the target areas that we would focus on: Arizona, Texas, Utah, Idaho, Wyoming, Colorado, Oklahoma, North and South Carolina, Tennessee, Minnesota, Florida, Nevada, Indiana, Georgia, North Dakota, Montana, Arkansas, Kansas, South Dakota. You're like, why did you choose those? Because we believe those are growth areas, business friendly areas that we feel we're not going to get into, difficult tax circumstances and complicated politics and stuff like that. So that's why we chose these areas. Go ahead. Sorry.
No, I just said, man, Washington didn't make it.
Sorry. Maybe someday. Again, I'm not saying we wouldn't go in those areas. We're just not targeting them. So if somebody comes in, they got a good story and it's in Washington, like if Mackie has a deal in Linden, Washington, I think when you and Caden bring us a $50 million apartment in Linden,
yeah, right.
All right, the investor aim. This has to do with the people we're focusing on putting money in the fund. Just so you guys have a little bit of understanding and education. That's what we're trying to do. The aim here is to really educate you guys today, feel more confident about what we're doing. Is ultra high net worth. These are people that have, net worths that probably exceed $20 million. RIAs, or registered investment advisors, are a huge channel that we'll be focusing on. We've done a huge scan of all of the investors, and we believe RIAs, or registered investment advisors. Those are people that, are wealth managers that have all these people's money and then they have to deploy it. And so we would use those channels. And then obviously family offices. These are people that have sold businesses, larger companies that sold businesses, and now they just have a family office that invests in different asset types. So those are the three that we've whittled down. We are not institutional grade yet. That'll take a second or a third fund when we do that. But for now, these are going to be the investor aims that we're going to go after. The investment, this will be a $350 million fund. Probably be one of the largest first-time funds out there. So we're pushing the envelope. We will have an A and a B share in the fund. And I'll walk you through that. So A shares, when we did a lot of research on this, there's two different investor types. The one investor type that says, hey guys, I just made a lot of money. I'm at the twilight of my life here and I'm not looking to take a lot of risk. So I just want to go to first base. I don't want to go all the way home. And so we just say you only have to take exposure of the risk up to 60% of the total capital stack. You will be the last loss of the exposure in there. That means if there's ever a loss, you'd be the last person to take the loss. And we will pay you an 8% internal rate of return. So they'll get a good return for very minimal risk, but they're not getting all that upside that somebody else would. So if you saw that bucket of money that we were talking about before, they would get a smaller portion of that, but we definitely would. Their priority, which means they're going to at least get up to 8% first. So they get kind of the first slice of the money till they hit that return. This just gives you an idea if you're looking at the model that we showed earlier. If their portion was $3 million that they put in, here's some of the interest they would get between the period of time, and then their increment they would get, less the management fee, and then the portion of the reversion that would get them to about 8.7% in this particular case. Again, probably not going to go higher than 8, but that was just in the model. And so just to give you an idea. So does that make sense? But so far, what I mean when I'm talking about an A share versus a B share?
Yep. I just wanted to quickly clarify. So whenever we're portioning out, they get up to 8%. So does that mean they get paid first? So they'll get their 8%, like say we have like a really high return on something. And just like for numbers wise, say it was like a overall like 10% return, they would get their 8%. And then I guess the B shares would
get the rest,
kind of retain like the extra that was like over because they took the higher risk.
100%. Yeah. So they would get the first bite of the apple, for lack of a better word, to get to their 8%. And then anything left over spills over to the B shares.
Okay, perfect. Thank you.
Yeah. Okay, so B shares, again, these are the people that are going above 60%. So they're saying, hey, we want to go to second, third, and home, and we don't mind swinging for the fences. And so they're the first loss position, and we're targeting to get them in the 12 to 14% IRR. We believe we can exceed that, but we always want to set expectations. And they obviously, in the 80-20 splits, we have this 80-20 split, and then we do this waterfall, which means that after 12%, the splits start to change a little bit more to our favor, just because it incentivizes us to continue to increase the returns, essentially. So again, more risk for them, more return, and they're obviously take the first loss position if there ever is a loss. And there, in reality, the way it actually works is every quarter we peel out about a quarter of a basis point to go into a loss reserve. So technically the loss reserve goes first, then actually the management company, which is us, takes the second portion of the loss up to the amount that we've invested. So if we put 300,000 in to the initial investment ourselves, we would take that loss up to that cap, and then the rest goes into the B share and then the A share. So there's a little bit of extra padding that we felt was appropriate as well. So again, just for the sake of our scenario, if they put in $1,250,000, they would get this interest from obviously what's been paid, the NOI increment, less management fee. We pay off the loan, and then they get the $593,000. Gives them about a 30% internal rate of return in this particular scenario. So they can get some pretty good returns, but they also take the risk. So that's just a high level. I mean, I tried to go through as much as I felt you guys could handle today. So that's all, folks, for you today. There's just the reference, which is pretty cool.
That was awesome, Dave.